Some of them have got listed even now. So what is the thinking now changing? We have seen some VCs who have suffered losses also because of falling valuation. What's the kind of conversation that goes around amongst your circle?
And so let's go back a bit and think about why invest in technology companies. The idea behind technology is that you can create operating leverage in the business such that you can over time exponentially grow earnings. Right? Pretty straightforward. I use technology. If I have a platform, instead of having incremental costs increase, my incremental costs stay the same and I grow earnings. So the second lever that I think exists in general within businesses is brand. And with brand, you can charge differentially for a product. And so as a result, you can both expand your margin by reducing your costs with technology and expand your margin by increasing your price with brand. And so that's the game that is ideally being played out. Now, the question is, what is the horizon in which you're playing? And what is the opportunity that you're going after? And I think this is where markets have been increasingly over time been willing to give longer and longer leashes to companies to say, okay, play it out a little further. Okay, go far, go farther, and you will get there. Now, I think that sometimes we go overboard. In every bubble or party or scenario where people get over enthusiastic, there are definitely going to be situations where it's unwarranted and companies don't make sense and businesses aren't the right businesses to do it. There are also going to be enough opportunities where businesses actually are achieving that and do have unit economics. Maybe they need to get to a little further scale, and maybe that needs to happen a little faster. I think that where we are right now in the juncture is there was finally a willingness for public market investors in India to accept the idea that they need to play in this game sooner rather than later. And I think that's very encouraging because you do need diverse sources of capital. Look, as a venture capital fund, I need to find liquidity. I go in early, I need to get an exit, I need to have other people carry the opportunity forward. And I think we're seeing that happen now. The result of public market investors being willing to buy into these businesses has meant that later stage funds are now also coming in as well. And so they'll carry it further. I do think it's dangerous when you have the public, the general public, trying to decide whether or not the business is right or wrong or whether or not the losses are justified. And that's why I think that the dot-com boom and bust, and now I'm dating myself, the late 90s in the Bay Area, that was what happened. You had public market, Main Street investors taking the risk of understanding whether or not a business should be public, should make profits, when it should make profits, how it should go. People were gambling. That's not right. I think if you have educated institutional investors buying into money-losing businesses with the expectation that they understand how they will grow and change over time and will work with them, then it's reasonable. But it has to happen at a more reasonable time frame. I agree with Ajay. Look, whether it's from the notion of having to contribute to the coffers of the government or from the notion of how you value a business, traditional methods of valuation have to come back into play at some point. When you think about how you value a business, discounted cash flows is what is the ultimate thing. If you have no cash flows to discount, then everything is in what's called the terminal value, which who knows what that is. Now, so therefore, the short answer to your question is, look, I think there's some leeway that needs to be given. Sometimes too much leeway is given, and people get over enthusiastic. But I think without a little bit of leeway given, then we don't get anywhere. And you're trying to change industries. We're not trying to change those small businesses. These are companies that are going after changing automobiles, changing jewelry, changing purchasing, procurement, everything. So I think we need a little balance of both. Is what I was saying.
Okay. So, Ritesh, I'll come to you. Sandeep rightly said that you need to give some leeway. But where does that end? We have seen companies going public, still not profitable, and writing in their their filings that the road to profitability is not clear, and then still they're raising money at high valuations and then falling. Not taking any specific names. So where does that leeway should end? Where should that end? I mean, as an investor, where would you want your investments, to become profitable?
So, look, again, I would say that we have to understand what the unit economics are expected to be over time. I would start when we invest in a business, we expect them to lose money. We know that that's the case. But we expect there to be an understanding of what long-term unit. So, let me say, look, first of all, looking at DRHPs and saying that a company says they may never make a profit is neither here nor there because they have to say that. Because if they're not making a profit today, by virtue of the way the things are constructed, they have to say they may never make a profit, and that's that. Now, the bigger question is, do they have a fundamental business proposition where cost drivers and revenue drivers will allow them to eventually get to unit economics that make sense? So, for example, I don't care as much about bottom line EBITDA today. What I care about is, what are your average order values? What are your conversion rates? What are your cost per acquisition? What are your margins? And are those? Can we understand how those will change at scale? The challenge becomes when businesses are telling you that if I get bigger, I will eventually make money, without you knowing what of those variables within it are actually going to change to let them make money. So I think we have to understand what will change. So it requires more thought. Maybe it's a little bit more complicated than the idea of buying the cash flows of a steel company. Maybe that's a little less relevant today, but buying the cash flows of a more traditional business, let's say. In our world, you actually have to spend a lot of time understanding why this makes sense. Why are people going to want groceries delivered at home in 20 minutes? What's the driver there? What are the economics that ensure that the transaction cost per delivery agent goes down? Why are people ordering jewelry online, and how does no inventory help make sure that you're able to provide better quality products to people? So as an investor in these businesses, it seems very easy to say that, look, it's a glamorous tech company. I'm buying into the tech dream. But actually, you have to spend a lot more time, I think, understanding the fundamentals of the drivers to then make a decision on what works and what doesn't. So it's hard to give you a unilateral view or a blanket answer, but I think what I would argue is spend time on the cost drivers and the revenue drivers. Don't spend time just on the high level numbers.